Happy Wisdom Wednesday, everyone. And book of the week this week is The Intelligent Investor by Benjamin Graham. Now, some of you may recognize this name right away. Yes, that is the Benjamin Graham who was not only the advisor, but the dear mentor to Warren Buffett, one of the greatest investors alive and probably of all time. Now, this is a very thick book with a lot of information in it, but Warren Buffett has told multiple times that chapters 8 and 20 of this book have been the bedrock of his investment strategy for the last 60 years. And he encourages every single investor to read those chapters every time you see the market fluctuate. Now, here's the thing, guys. I am not a certified financial advisor, and I should say that you should never take advice from anyone who's not a certified financial advisor, especially a guy who's devilishly handsome in his book reviews. But I'm going to share with you what I learned from Chapter 8. And I do recommend getting the edition of the book that has commentary by Jason Zweig. Jason is a columnist for the Wall Street Journal, has written about investing in personal finances since the 80s. Plus, he has a knack for neuroscience, which is a big part of Chapter 8. So let's get into it. Now, Chapter 8 is called The Investor and Market Fluctuations. And I want to read to you a quote that Jason Zweig added to here that I think is very fitting. And the quote, as I'll put here for you to read, is by Marcus Aurelius. Yes, that's right, Marcus Aurelius from the Meditations book that we've gone through many, many times that you should definitely get. And the quote says, "The happiness of those who want to be popular depends on others. The happiness of those who seek pleasure fluctuates with moods outside their control. But the happiness of the wise grows out of their own free acts." So what does that mean? Let me tell you. Now, on the other side of my office, I have the Cognitive Bias Codex. Now, as you can see, I have nothing but a bunch of cognitive biases that surround this entire brain. And what is that all based off of? Emotion. Because at the end of the day, a lot of times, actually all the time, we make decisions emotionally. And the investor or person who allows their emotions to sway them ends up being pretty miserable. But those who are able to act freely away from the emotion, especially from the emotion of the crowd, those are the people who are in true control. Now, one of the most brilliant metaphors that Ben Graham came up with was the idea of Dr. Jekyll and Mr. Manic, just like Dr. Jekyll and Mr. Hyde. You see, the manic Mr. Market doesn't really price stocks the same way that you would normally value a business. You see, when the stocks are going up, he'll gladly overpay what their objective value is. And when the stocks are going down, he'll frantically and very depressively sell them way below their value. Now, is Mr. Market still around? Is he still bipolar? Yes, he is. And you better learn how to deal with him. Let me give you an example of how bipolar Mr. Market is. So if you look at a company like Inktomi, which hit its all-time high in 2000 of $231, it nearly tripled its value in a few weeks, almost 1,900%. How exactly did that happen? Well, the answer is kind of obvious, right? Growth. They were selling a lot of product, millions and millions of dollars, and it kept going up and up and up every quarter, except one problem. See, Mr. Market overlooked one tiny detail, and that was Inktomi actually didn't make a profit, ever, not even a dime. So they were actually at a loss, always. And unfortunately, within 2 quick years, Mr. Market got incredibly depressed, and after valuing this company at about $25 billion, that's $25 billion with a B, 2 years later in 2002, Inktomi became worth 25 cents a share and $40 million. Now, eventually, what ends up happening is that Inktomi ends up being bought out by Yahoo for about $1.65 a share. And the question that everyone wants to ask is, what exactly changed? And the only thing that changed was Mr. Market's mood. You see, the one thing that Ben Graham was getting at here is that when it comes to investing, and I think a lot of things in life, would you let a certifiable lunatic show up to your house 5-6 times a week to tell you exactly how he feels and how you should feel at that same time? Absolutely not. So you shouldn't let the market or people or society do the same thing, right? Sometimes change, not just sometimes, all the time, happens not within days or weeks. Sometimes it takes months or years. And so having this reaction of constantly going with the mood of the crowd is actually very detrimental. Now, what should you do? Should you ignore Mr. Market? Absolutely not. What you should do is do business with him, but only to the extent that it suits your needs. His job is to provide you prices, and your job is to look at those prices and decide whether they're worth something or not to you. And you don't have to do business with him no matter how much he ends up begging you. Now, check out this one quote from Graham. It's actually one of his most powerful insights. The investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is perversely transforming his basic advantage into a basic disadvantage. Now, what does he mean by that, basic disadvantage? What he means is that the intelligent investor has full freedom to choose whether or not to do business with Mr. Market. And that's the key, full freedom. Objective control over his emotions and feelings. Now, the mistake that a lot of people make, whether it's in business or investing in markets or anything, is trying to beat the pros at their own game, when in reality, they can't even beat themselves, right? You're not going to be better than a professional investor. So what you can do is control the controllable. And of course, there's a fantastic list of these things of what you can control. And at the very bottom, most importantly, is your behavior. And think about it. So many things in life, whether it comes to business, relationships, everything has to go back, or you can at least map it back to controlling your behavior and influencing it. So why is it that this happens not only to investors but everyday people all the time? Well, see, the thing is that we're actually hardwired to look for trends and patterns. And unfortunately, even though it's evolutionary hardwired into us, we're really bad at it. And that's something that Scott Adams in his new book, Loser Think, points out, is that we think we're picking up on a trend or pattern, but in reality, it's just not true. See, it turns out that the reason why we're bad at doing this is that it's so hardwired into us that even when scientists do studies and tell a group of people that, hey, we're going to show you some patterns, but there's actually no pattern to the things you're about to see. There's no predictable event that you're about to see, nothing, we still find a way to make a pattern out of it. Now, this is a great time for me to go back to my old medical school textbook and refer back to anatomy so we can actually see how that works. Let's take a look. What we want to focus on is this little area right here, which is the anterior cingulate cortex. Now, looking at the brain, there's areas called the anterior cingulate and nucleus accumbens. Now, these areas light up in anticipation when we start to see a pattern and trend. And if the event reoccurs again and we feel like we're catching a pattern, a soft bit of dopamine is released. And that obviously causes a nice bit of euphoria. We like that feeling. And it can get very addictive, obviously. Now, what about when you lose things? Well, see, when you actually lose something or you don't catch a trend, another part of your brain fires up, and that's the amygdala. That's where a lot of emotion, your fight or flight responses end up residing. And psychologist and behavioral economist Daniel Kahneman, who won a Nobel Prize in his book Thinking Fast and Slow, shows that the psychological pain of losing something is way greater than actually gaining. So when you lose $1,000, it is a lot more alarming and your emotions are a lot more sharper than gaining $1,000. It's a good piece of knowledge to keep in mind. And if you think about it, that guides quite a lot of your decision making, which is the concept of loss versus gains. Now, let me leave you with this last piece of advice. The moment when you're in most control is when you realize that there are a lot of things that you actually do not have control over. And at that point, you're probably going to be your most powerful. So with that said, that's your book of the week. Definitely get out there, check it out. I love this edition where Jason Zweig provides his comments. And, be sure to check out his column, The Intelligent Investor. I definitely think you'll love it. So, as always, happy Wisdom Wednesday, and I'll see you next week.